Okay, so I have a question for you before we get rolling. Because the holidays are coming up. We've got Thanksgiving coming and Christmas, of course, and so on, New Year's parties, etc. If I were to invite you over for a holiday party, what dish are you going to bring?
The question might be, what, if I was going to make a dish, the only thing I ever bring, I think the only thing I've ever made.
Okay, now we're getting to the
this is going to sound so childish too. I make Rice Krispie treats.
Okay. All right.
If it's going to be cooked, like if it's going to be something used for like an actual meal, to be honest, I'm not cooking. It's probably I'm going to go buy something, or my wife's going to make it, or
who doesn't? But who doesn't love Rice Krispie treats? What would Linda make? Do you think?
I don't think she has a go-to. It's funny, like her best friend always makes like artichoke dip, and so like that's like her staple. We don't have a staple. Like Linda will sometimes bring these Brussels sprouts that people love, but like I hate Brussels sprouts.
Oh,
and I know people hate Brussels sprouts, so like it's not something I'm ever going to ask for or crave.
Well, and you eat like your body is a garbage dumpster. And so it doesn't surprise me one bit that Rice Krispie treats that's your move. That's your move.
Probably been my move since I was like 7 years old too.
Oh, we still have the chart up here. All right.
What about you?
What am I bringing? Probably some sort of dip. I love buffalo chicken dips and stuff. So probably something along those lines. Kind of depends what kind of party. If I'm asked to bring a pie, I'll bring a pie. I won't make a pie. My wife will make a pie. But if I'm asked to bring an appetizer, probably some dip. I have a cheese ball I like to make, but these are not healthy choices for
well, it's holiday party.
It's a holiday party, right? Let's go nuts. All right. Well, without that critical stuff out of the way, let's pop in. Let's start with the market recap, and then we'll get to the charts and then wrap up with what's on our mind. Sound good?
Sounds good.
All right, let's do it. Okay, welcome back. If you are a regular viewer, welcome back. If you're not a regular viewer or listener, because this is a podcast, right? This is the Casual Friday Financial Insights podcast, where we post every other Friday or 2 Fridays a month, bi-monthly. I think we skipped an upload there, Ryan, because there were 3 Fridays in October or something.
Yes, correct.
At any rate, we're back again, the Casual Friday podcast. I would say if you're listening, we post this on Apple Podcasts, Spotify, all of wherever you get your podcasts. So I'd encourage you to subscribe. If you are watching on YouTube, I would say subscribe to your YouTube channel. That way you can actually see the charts that we're referencing. It's not required, of course. I know some people are listening to this while they're running or doing out in the yard. One particular listener is down motorcycling through Patagonia right now, and so he's probably listening and not watching on YouTube. But either way, however you're getting this, I would encourage you to subscribe so you don't miss any of these. And we'll have some more guests coming on as well as we close out 2023 to talk about some of the wild things that are going on generally. But this week, Ryan, it's you and I, and we're kind of talking. Well, we're going to start with the market recap, right? So let's do that. Not a bad start to November, is it?
No, much better than we've been experiencing. I think most of our podcasts, this part of the podcast has been kind of dreary just because the markets have been down. It seems like the last several podcast episodes. So it's nice to have a turnaround.
Yeah,
large part probably because of the Fed. Like that's been the main story throughout these podcasts.
Rates are driving this, right? Rates are driving this. NASDAQ, we're recording this earlier in the week, of course. NASDAQ finished higher again, longest winning streak since November of 2021, which is nice. What we're looking at right now through Tuesday's close are the markets in there. And if it's too small to see, if you're watching on your phone, if you're just listening, NASDAQ month to date. So this is just November, up more than 6%, S&P 500 up more than 4%. Russell 2000 small caps up again, more than 4. Dow's up 3 1/3. But as we pull the lens back, we can see, the last 3 months, NASDAQ's at break even, but some of these other indices are down quite a bit. And, last 6 months still positive, but it's been quite a roller coaster ride. Markets essentially peaked for the year still at the end of July, and they legged lower in August, legged lower in September. I think we all had high hopes for October, and they just weren't coming true because rates spiked. We got to November 1st. The Federal Reserve said that they weren't raising rates. They left the possibility open, but I don't know. Do you believe them that they're going to raise rates?
No, nothing. I don't think anything's changed, and maybe that's the optimistic point of what the Fed said when they came out, was that really interest rates probably are going to be at where they are right now. No rate changes
Right.
for the short term, and then we'll see what happens next year. But there was nothing startling. I think that's a lot of times what happens when the market goes down, based upon what the Fed says, is that they ended up changing some of the language unexpectedly from what the market expected, and then the markets would run downwards.
Right, and that came in combination with some slowing growth. Unemployment rate has ticked higher. We're at 3.9%. That's not in one of the charts here this week. Maybe we'll do it next time. But has gone from 3.4 to 3.9. Not that we want people unemployed, but these are all signs of a softening economy, which then would in turn suggest inflation is starting to ease, which in turn would suggest that the Federal Reserve doesn't need to keep the beatings continuing with the increase of rates on the short end of the curve. So I don't know. It's hard to know where we go from here. The next Fed meeting is a little bit more than a month away. They meet December. They meet in the middle of December. I think it's the 13th is when they'll announce the results for the next meeting. I posted something on LinkedIn. I mean, basically, no rate increases are priced into Fed futures for December, and the first pricing in of Fed rate cuts could be as soon as March. I mean, the odds aren't high, but they are still more likely than a raise, I guess. So
Well, the other thing too, last week with the markets running up, it actually helped. The bond market was running up as well,
Yep.
which is nice for people's portfolios. Obviously, people have a balance of bonds and stocks, and so it's nice when both sides of those portfolios, as they were kind of going down last year, both at the same time.
Yep.
This last week they both run up, so it's been a good start to November with bonds and stocks.
Yeah. So I think some signs of optimism, or markets have kind of rebounded off of the real lows, although the jury's out on how we're going to finish out the year, I guess, is really where this lands us. Let's roll to your chart here, Ryan. You've got one here. We're talking stocks. This is the S&P 500. And the year-to-date performance is the black line here. Is it saying 6.75% roughly through the end of
October,
almost the last week of October. Talk to us about what we're looking at here.
Yeah, we've mentioned this in like some of the other podcasts, the Magnificent Seven, which is really the 7 largest companies inside of the S&P 500. Most
Mega
of
cap
these,
tech.
yeah,
Right.
mega caps. Yeah, I mean, you could really kind of classify these as technology stocks, and it's made for a very interesting year like I've never experienced before, where such a small group of stocks have really made up the return of the S&P 500. So basically what this chart is showing here, as Brian has mentioned, the black line represents all of the S&P 500. One thing to note is that the S&P 500 is market cap weighted. So the biggest stocks, their performance dictate the performance of the stock more so than the smallest companies. So that's why, obviously if 7 stocks were doing significantly well, but they all were equal weighted, meaning all 500 companies in the S&P 500 had the same weight, this wouldn't make that much of a difference. And there is an indice that represents that, but the S&P 500 again is cap weighted, so these 7 stocks do have a good representation of the overall indice. And you can see in the chart that the Magnificent Seven is represented by the red shaded area of the chart, and it is the whole reason why up until late October, that the S&P 500 is positive or was positive for the year. In fact, the other 493 companies represented by, I don't know, I want to call that the bluish gray
Yeah.
shaded portion of the chart, they were actually down for the first, almost 10 months of the year. And
Right.
so there's really kind of a big, significance between the mega cap stocks of the technology stocks versus everything else.
Yeah. Well, I don't know that everybody watching and listening understands what cap weighted versus equal weighted means. Essentially, the bigger the company, the more size it takes up in the S&P 500. And the S&P 500 makes up the 500 largest companies in the US, right? So the bigger the company, the bigger the influence. And that's really where it comes here. If you exclude those 7, like you said, the remaining 900 or 493 are negative for the year. So the only reason the S&P is positive at all versus, and much as positive as it is really because of those names. I think we call that bad breath, don't we?
Yes, yeah. When it's a few stocks leading the way, you have like this bad breath with it's just a mechanism of kind of seeing how strong the market is. Um, there you can argue too that a lot of this that we didn't really see coming, obviously, was the AI revolution that kind of happened over the last year. A lot
Yeah.
of these stocks are affected by the momentum of what's happening with AI, and so these a lot of these companies are touched and are a part of it, and so that has definitely helped them over the course of the year.
Yeah. I think it really, this chart is a good one. It's from Bianco Research, Jim Bianco. I will link to both his tweet that contains this chart and his Twitter account in the show notes here, whether you're watching on YouTube or just in the listening on this. We'll include that reference here, but it really goes to show that even though the S&P 500 is up still respectably on the year, if you kind of just peek underneath, it's not as good as it seems, right? Is that the takeaway here?
Yeah, I think the takeaway is that we all kind of diversify to allocations within a portfolio, and it shows really that you have to have these large mega technology companies inside of the portfolio to be positive for the year. Because if you were on the flip side having mid cap, smaller company names inside the portfolio, those definitely have not performed as well.
Right. Right. Um, well, I don't want to say this. I mean, thank God for diversification and thank God for the Magnificent Seven this year. Um, but it's reasons to remain cautious, I guess, even despite this little run up that we've had to begin November. Um, I will say, so I've got a chart that kind of is similar, but not the same. This is stock market, bull and bear market cycles. Going back, gosh, this actually is the price index of the S&P 500 with the start of bear markets and bull markets adjusted to zero, going back to 1956 is how far we're going back. And you can see the little stretches of bear markets and bull markets. The shaded area here are recessions, and so you can see the really big one in 08 and the brief one with COVID. But if we were to zoom in, you can see that we are still below our all-time highs that we were at the beginning of 2022. And so I think a few things jump out with this chart. One is the bull market cycles last much longer and go higher than they last longer than bear markets. Bull markets last longer than bear markets, and they go up higher than bear markets go down.
Yes, I
Right.
think a nice takeaway too of this is that, from kind of a mental standpoint, it's good that the markets work this way, which is, when the markets do go down, it's for a much shorter period of time. I think it'd be much more difficult to invest into markets if you were down for significant long periods of time. And I think that would be taxing. It'd make people less inclined to invest
Yep.
into the market. But when you see that the markets go up a lot more often than they go down, I think it just helps people to weather the storm when things are bad.
Yep. Yeah. Well, and just for some context here, so you can see kind of in the chart here that bear markets are considered, for the purposes of this discussion, bear markets are 20% declines in price from the prior peaks, and then bull markets, in hindsight, begin at the bottom, right? Uh, we don't know if we're at the bottom yet or not, but since 1956, the average bear market has lasted 1 year and 2 months with a decline of 36%. We are 1 year and 10 months into the current bear market, so a little bit longer than the historical bear markets on average, but we're down 25% from the peak versus an average decline of 36%. Um, Now, there's lies, damn lies, and statistics. So I don't want to put too much weight on how this compares to the average. But if you did, you would say this has gone on a little bit longer than normal, but we still have a ways to go to reach those bear market lows on average. In 2020, it was 34% from the peak. 2008, it was 57. The tech wreck, it was 49%. And you can even go back to the late 80s. 1987, it was 34%, even though it was just really brief. Before that, in the early 80s, 80 to 82 was 27%. Right. So 25% for a bear market cycle is
It's
not
pretty
that
mild.
deep. It's been
Right.
going on for a while, but it's not that deep.
Yeah, the last time that we've had, a bear market, we would say roughly around, or this shallow, was, in the 60s when it was down 22%. So
Yeah.
it definitely has been a shallower fall than we've had in recent times of bear markets. But as you mentioned, it doesn't necessarily even say that this is it. Like we
No.
can't definitively say that the 25% that we saw fall that we experienced last October, that was it.
Well, and
Um,
it's understandable also why the people are starting to run out of patience. We're almost 2 years into this because it really began at the beginning of 2022. Um, this has gone on longer than '07 to '09. This has gone on longer than 2020. Now the tech wreck was extended because of 9/11, I would say, and some other like Enron accounting scandals. So that went on a bit longer as well. But this has stunk for a while, and that's probably why I think. And you add in the fact that the bonds haven't performed very well, and people are kind of getting fed up with this, understandably. But if you pull the
you've had
lens back and you see this, I think an important contrast here, because the average bear market is a year and 2 months with a decline of 36%. Average bull market lasts 5 years, 9 months with an average return of 192%. That's a fair trade-off. And the last bull market was for a year and 9 months, so very short in comparison, up 114% from the bottom from when with COVID kind of disrupting in there. So,
have you had clients discuss or call you about the length of which it seems like we've been in this market? Things continue to go down month after month.
not specifically. They haven't said, "Hey, this is going on for a really long time." I think a lot of people think of just as human beings, we start to categorize things, and so a lot of people look at this and say, or not look at this specifically, but look at how the year has gone, and they say, "Well, last year was a bad year. I thought this year was going to be a good year," as opposed to stringing this all as the continuation of the same event.
Sure.
And so there's this idea, well, we were negative last year. We ought to be positive this year. And we may be positive this year. It just may not be enough to make up for last year. It may take another good year or finally kind of finding bottom and then propelling out of this. I don't know if we'll find bottom and propel out of it as we get into a presidential election year, but who knows? But the spring is coiled, you could say. The longer we kind of bump along and go past the average, bear market here, I would say it becomes a little bit more of a coiled spring to where we start getting some good news and inflation's under control and interest rates might start coming down. We could shoot higher because we've been down for so long.
Yeah, I think there's two ways for like the market to sometimes have that spring effect where you have a really good year. One is obviously you when the market goes down very significantly in one year. When it finally bottoms out and starts to go up, it usually is very sharp. As you mentioned, the other way is if you could, yeah, you sometimes have times where the markets goes down for several years in a row or a couple years
Yeah.
in a row. That too can also lead to some significant turnarounds and when the market comes. So
Yeah.
kind of the reason why you got to stay in.
I will say the end of October did start to feel like that kind of capitulation moment. I don't think it became that because of what the Fed did last week and with what the Treasury is doing with their bond. There was a rally, right?
Yeah.
But I think the thing that sticks out not only is that this is long, is that we have still not met that capitulation stage where we're down 30 something from the peak, and we might
Well, we
need to
haven't had those, violent days where the market goes down significantly for several days in a
no.
row.
It was
It's
painful
been a
last
slow
October.
bleed.
It was painful last October, but
Sure.
one could argue that this has been a bear market rally in the first half of this year. I don't. We'll only know that in hindsight, and all we can do is kind of stick with the retirement plans that we've got and say, hey, this is what we see coming forward in the next 12 months. We can be conservative until it's time to be opportunistic. In the meantime, we want to make sure that we're running our plans and refreshing those and keeping those going. So, um, you know, I think this was an interesting one, and one I'll probably keep an eye on. This chart is one of ours. And so what I will do, I'll actually post this on LinkedIn, and link to that way in the show notes. So if you want to take a look at this for yourself, you can do that. But yeah, an interesting chart nonetheless. Okay, well, with our charts out of the way, what's on your mind these days, Ryan?
So not a lot. I came across a podcast and it just sparked some interest and some thought. So David Freeberg of the All In was kind of
Mm-hmm.
mentioning kind of the storm that hit Acapulco, and kind of like how it wasn't forecasted. It got worse real quickly, but then he led into the discussion of insurance, and how insurance is becoming and can become even more unaffordable, maybe for those people on the coast. We've dealt with fires. He had mentioned obviously the fire in Maui, and how that will likely raise insurance costs. We've had our fair share of fires that we've had to deal with over the last several years. And I had looked up one, actually in particular, an article came across my feed. The residents of Paradise, which were affected 5 years ago from the fire,
Mm-hmm.
they recently had their um, insurance kind of re-upped just recently. Surprisingly, it took this long, to be honest with you, but their insurance went from somewhere around $1,800 a month to like 10,000 just recently,
Oh
a
wow.
year. And so it's kind of, it was just interesting that he had mentioned, with kind of the weather patterns, and you can argue what's the cause of that, and there's just a lot of things going on that can cause the devastation, which then has an effect on insurance and whether or not people can afford it. Do you end up leaving, the area because you can't afford it? Do you have some people that decide to stay, they don't insure, but they
Yeah.
just, they self-insure or just wait to see if something happens? It was interesting. It was just a real interesting thought. Just because, again, being in California, I think we've been exposed to this. We do have an ocean here, so there is an impact that can have as well. Um, yeah, it was just something that was interesting that
It's
was
interesting
came
he's
to
talking about
mind.
that because Axios had an article not too long ago about insurance and how the premiums are going up. And it's actually the effect of inflation on premiums. So you're talking about maybe like homeowners or insurance on a vacation home that may be coastal, but even things like just your regular homeowners insurance or your car insurance has gone up. And the reason being, it costs more to fix your car,
Right.
costs more to fix your house. You get an fender bender that's going to cost a couple $1,000s instead of $1,000 where it was a couple of years ago. And so those costs are being passed along to people. And so insurance costs are going up across the board.
Yeah, one of the interesting things with car insurance that may have had effect, was the rise in car prices. Astronomical rise in car prices, used and new,
Yeah.
during COVID. The insurance companies needed to factor that in at some point. That
Yeah.
cars got really expensive, and so if they got in an accident, had to replace them. They're a lot more. They were a lot more expensive in 2022 than they were in 2020, for sure.
Sure. Yep. Yep. It's all getting more expensive. As far as what's on my mind, I don't have a whole lot these days. We're getting ready for the holidays. Some of it has me thinking about charities and charitable giving. I think that's something that a lot of people do, but maybe don't do with quite as much thought as they could. Whether it's being deliberate with your money, and trying to maximize it. One of the things that I've learned over the few years is that you see can drives for the food bank, right?
Right.
And you can give cans and you can buy boxes of macaroni and cheese and donate those things. But with the food bank, they can buy a pallet of food for $80, a pallet of food. And so you can actually get more out of your donation by donating money to the food bank versus donating cans, for example. And it's really interesting the way they do it. You know, they give food to people who don't have a place to cook. So they'll have food bags for like homeless, where it's like ketchup packets, but it's peanut butter and jelly, right? You know, giving turkeys to people at Thanksgiving is great, but they have to have an oven.
Right.
And so I think there's some interesting things we've talked with. I've been working with clients lately on, you know, they're taking their required minimum distributions out of their IRAs and using that as a way to give charitably, so they can satisfy their RMD requirements, give to the charities that they're interested in giving, and offset the tax implications of having to draw an RMD when they don't need one. So I think as we get in the holidays, the thing that's on my mind is being purposeful and thinking about charity and charitable giving, and being purposeful about it so you can make the most of it.
Yeah, I think that's like our job as advisors to talk to clients about them, make them aware of the different ways of doing it. Because
Yep.
I don't think I will say most clients probably are not familiar with taking out the required minimum distribution
Yep.
and giving it to a charity. That's not something that they think of as a strategy.
Yeah.
And maybe it allows people as they talk about it, think about, hey, well, I can save on some taxes, give some money.
Yep. It can be a
And just be
win. It
good.
can be a win across the board. And you know, it doesn't make sense for everybody with the standard deductions being increased. There are a lot fewer people itemizing, and so that may play into what their charitable ideas are. Um, you know, I don't know, but for people who are charitably minded and are giving, um, just I would say what's on my mind is, and this is for our family as well, taking a pause and saying, what are our intentions here and how can we make the most out of these intentions so we can have the largest impact. So something to consider as you head into the holidays.
That's a good one.
um, I will follow up on just a totally different note. As a follow-up, with 2 months ago we were talking EVs, right?
Yeah.
I finally, at the urging of my wife, finally just said, okay, I'm going in, I'm doing the Rivian. So
Okay.
they sent me the email, confirm your configuration. And so I'm locked in. I'm locked in for a Rivian
Wait,
sometime
what
next.
color?
Green.
Great. Oh, so the forest green, that
Yeah, it's like a
dark green.
forest green looking thing.
Okay,
Yeah.
that's nice. That's nice.
Yeah. So
When is it coming?
January, February, maybe next year. I still
Okay.
don't have a hard date.
Okay.
But what they did was they actually confirmed my address on where to send the charging thing so I can install it.
Yeah.
So my next,
You have to get an electrician
I got to
over.
find an electrician. That's exactly
Yeah.
right. Yeah. So that's the other thing on my mind, is finding an electrician.
Well, if it comes early, it's a nice Christmas present.
Yeah. Well, so the funny part is the deposit for this thing was a Christmas present from my wife 2 years ago. She put the deposit down on the Rivian because I talked about it and wasn't doing it. So she put the deposit down and bought me a Rivian sweatshirt.
Yeah.
And so this is a Christmas. This is the culmination of a Christmas gift that was 2 years in the making.
Well, it's a good
Um,
one though. It's
yeah, so it's going to be a good one.
your
Exactly.
first EV.
That's right. So, well, cool. Well, Ryan, let's leave it there. I think we're going to try. I don't know. I don't know what our schedule is going to be, because our publishing schedule would have us publishing the week of Thanksgiving. So we'll see. We might record a couple early and have some evergreen episodes that we can post here over the holidays. We'll see, but we'll keep posting through the end of the year. So if you haven't already, again, I would say subscribe. You can email us at info@FordFG. If you see something on here that causes you to have a question, you can always email your advisor here at Ford Financial Group. Subscribe to the YouTube channel, subscribe to the podcast, wherever you're getting your podcasts. And so that way, over the next couple of months, you can hear us, hear our guests, and don't miss an episode. So we'll leave it there, Ryan.
All right. See you in a couple weeks.
All right. Sounds good.